Recent concerns have come to light about the banking system. What's going on and should we be worried? Find out on this week's video market update. So you may have seen in the news that two banks, Signature Bank in New York and Silicon Valley Bank in California, have both been put into receivership because essentially the banks have failed. So how did we get to this point? And is this something that we should be worrying about? Signature Bank is different. They're a bank that has really evolved into lending around the crypto space. So unless you're heavily invested in the crypto space, I don't feel like that is really analogous to any other banks. We can put that one over here. The bigger concern is Silicon Valley Bank. That is a very well-respected bank that's been around for a number of years that primarily focuses on tech startups and companies in Northern California. The issue with Silicon Valley Bank is they were the largest bank failure since 2008 and the second largest bank failure in US history. They were the 16th largest bank, so when they go under, it creates concern even if you're not in the tech space. Why did it go under and why has it been seized by regulators? Really the biggest effect on this has been the rise of interest rates. Interest rates have risen so aggressively that it's had an effect in two ways. One, a lot of tech startups who need access to capital can't get that capital at the same cheap rate because interest rates now, instead of being essentially zero, maybe 5 or 6 or 7 or 8 or even 10% on a loan. And so instead of going and getting a loan and paying that interest, these companies were going to the bank saying, I would like my deposits back. There became a run on the bank when a number of venture capital firms went to their clients and said, take all your money out. When you have 50 venture capitalists who can go and control 1,000 companies and they're all telling their clients to get money out, that caused an artificial run on the bank that you wouldn't normally see at a regular bank like you and I might bank at. The other issue is that Silicon Valley Bank did not manage their risk duration well. What does that mean? That means they took their short-term reserves that were meant for, giving their money back to their customers and they bought 3-year treasuries. Probably because they haven't seen a run on the bank and so they haven't needed this access to capital. So they took the deposits, they bought 3-year treasuries. Well, when people wanted access to money, what did they have to do? They had to sell those treasuries at a discount. They had to take a loss. And then there was just less money to pay out to their customers who needed their money back. And so this has been an issue because it's a well-respected bank who just last week was listed on Forbes's list of the best banks in America. And your friend and my friend, the always prescient, insert sarcasm, Jim Cramer had this to say about Silicon Valley Bank.
I think the fears were not justified, and it's a very compelling situation. Hey, by the way, long-term private equity and venture capital, they're not going away. Being the banker to these immense pools of capital has always been a very good business. Stock's still cheap.
So it came as a surprise because it was a very strong, very well-respected bank, but that the run on the deposits was created by the venture capital firms that were going out and saying, hey, take all your money, take all your money. So does that mean that that's a bigger, larger contagion issue in the banking system? As it currently sits, I think the answer is no. I think these are two niche banks that didn't manage duration well, that have a very specific clientele that's been negatively affected by the volatility and the uncertainty and the rise of interest rates. But one good news came out that the FDIC has a deposit insurance fund. So that's not taxpayer money. That is money that's held at the FDIC. That money will be used to make all the depositors whole, not just up to the 250,000 number, but all depositors. And what we're being told anyway is that that money is coming from the FDIC fund, which is paid for by quarterly dues from banks, not the taxpayer. So that's what we know at this point. A lot can change. We may find out a lot more in the postmortem, but I just wanted to give you an update of why we got here, where we are. The large question is, should you be concerned about your bank? I would say that if you're at a larger bank, the banking system is strong. If you're a small regional bank, if you have more than 250,000 in that small regional bank, you may want to diversify potentially you've got to look at your own situation. I can't make a recommendation because I don't know your situation. That at this moment, it does not feel like there is a contagion running through the banking system, but these kind of niche banks that did not manage risk well are suffering the consequences. So if you have any questions on that, if you have any questions on anything else you're seeing in the news, give me a call or send me an email. If not, I hope you make it a great week.